a stock drops 50%. You might look at it and think, wow, this stock is cheap now. But is it actually undervalued? Not necessarily. A stock can fall 50% and still be expensive. And sometimes, a stock trading at a much higher price can actually be the better deal. So in this video, I'm going to show you a simple way to figure out whether a stock is actually undervalued without making this overly complicated. Let's start with the basic idea. A stock is undervalued when the price you're paying is lower than what you believe the business is actually worth. Think of it like buying a house. If a house is worth $300,000, but you can buy it for $220,000, that's potentially a good deal. Stocks work in a similar way. The problem is, with stocks, we don't know the exact value. We're estimating it based on things like earnings, cash flow, growth, debt, and the company's future. So the goal isn't to find a stock that simply looks cheap. The goal is to find a good business selling for less than it's reasonably worth. The first thing I would look at is the PE ratio. PE tells you how much investors are paying for each dollar of a company's earnings. For example, if a company has a PE of 10, investors are paying $10 for every $1 of annual earnings. But here's the important part. Don't look at PE by itself. Compare it with the company's historical PE and with similar companies. Let's say a company normally trades around a PE of 20, but today it's trading at 12. That could be interesting, but you also need to ask, why is the PE so low? Maybe the company is temporarily struggling, or maybe its earnings are expected to fall. A low PE doesn't automatically mean undervalued. Sometimes it means investors see a problem that you haven't noticed yet. Next, look at the company's growth. Start with revenue and earnings. Is revenue increasing? Are earnings increasing? And more importantly, are they increasing consistently? Imagine two companies. Company A trades at 15 times earnings, and its earnings are growing 15% a year. Company B trades at 8 times earnings, but its earnings are falling 20% every year. Which one is actually cheaper? Company B looks cheaper at first, but it could be a value trap. That's why valuation always needs to be looked at alongside growth. Next, look at free cash flow. This is one of my favorite things to check because profits can sometimes look good on paper, while the actual cash situation tells a different story. Free cash flow is basically the cash a company has left after paying for the investments needed to keep the business running. So ask yourself, is free cash flow positive? Is it growing? And is the company consistently generating cash? If a company has strong earnings and strong free cash flow, that's generally much more interesting than a company whose profits aren't translating into cash. You can also look at something called free cash flow yield. It's basically the company's free cash flow compared with its market value. The higher the yield, the cheaper the stock may look relative to the cash it's generating. Again though, context matters. Now let's talk about debt. A company can look incredibly cheap because the market is worried about its debt. So before getting excited about a low valuation, check the balance sheet. Look at how much debt the company has. Then compare that with its earnings and cash flow. Also look at whether the company has enough cash to handle its obligations. Think about it this way. Two companies might both trade at 10 times earnings, but one has almost no debt, while the other has billions of dollars in debt. Those two companies aren't necessarily equally attractive. The cheaper-looking stock could actually be much riskier. Now we get to the most important part. You need some idea of what the company is actually worth. There are several ways to do this. One simple method is relative valuation. You can compare the company's PE, price to free cash flow, or other valuation ratios with its historical averages and competitors. For example, if a company normally trades at 20 times earnings but is currently trading at 14, you can start asking why. Another method is discounted cash flow, or DCF. Don't worry, you don't need to become a math expert. The basic idea is simple. You estimate how much cash the company could generate in the future, then calculate what those future cash flows are worth today. Let's say your analysis suggests the business is worth around $80 per share, but the stock is currently trading at $55. That doesn't automatically mean you should buy it, but you found something worth investigating. And this is where the margin of safety comes in. Let's say you calculate that a stock is worth $80. You probably don't want to buy it at $79 and assume your calculation is perfect. Your estimate could be wrong. Maybe growth is slower than expected. Maybe profit margins fall. Maybe competition gets stronger. So instead, You might want to buy only when there's a significant gap between the estimated value and the market price. For example, estimated value is $80 and market price is $55. That difference gives you a margin of safety. It's basically a cushion in case your assumptions aren't perfect. But there's one final thing you need to watch out for, and that's the value trap. A value trap is a stock that looks cheap, but keeps getting cheaper because the underlying business is actually getting worse. So watch for things like declining revenue, falling earnings, weakening free cash flow, increasing debt, shrinking profit margins, or an industry that's slowly becoming less attractive. If you see several of these at the same time, a low PE ratio isn't necessarily a bargain. It might be a warning sign. So, before you call a stock undervalued, ask yourself 5 simple questions. Number 1, are earnings growing? Number 2, is the company generating healthy free cash flow? Number 3, is the debt manageable? Number 4, does the valuation look cheap compared with reasonable benchmarks? And number 5, is the stock price meaningfully below your estimate of what the business is worth? If the answer to all 5 is yes, you may have found an undervalued stock worth researching further. But remember, cheap doesn't mean undervalued. A stock is potentially undervalued when you're paying less than the business is reasonably worth, and the business itself still has the fundamentals to support that value. That's the difference between buying a stock because it fell and buying it because the numbers actually make sense.